Alright, you are enrolled in this course on algo trading for cryptocurrencies, and it seems that you have already decided that crypto could be the right asset for trading and investing. That's great, but as always, there are pros and cons, and in this and the next lectures, I will highlight some of the most important characteristics of cryptocurrencies. And also we will compare cryptos to traditional currencies like a US dollar and the euro. And finally, I will cover the pros and cons of cryptocurrency trading. So I think you already know most of it, but it is definitely worth knowing and understanding the key aspects of cryptocurrencies before we are going to invest and trade cryptos. So in finance and investing, market participants typically differentiate between conventional assets and alternative asset classes, and listed stocks and bonds are clearly conventional asset classes, and every serious long-term investor holds the stocks and bonds, and we could also split bonds into government bonds issued by countries and corporate bonds issued by companies. And actually, conventional stocks and bonds are listed and trading on major exchanges. And literally everyone can just buy and sell them on an exchange or with a broker. And third, we have cash or cash equivalent holdings of traditional currencies like US dollar, euro, or British pound. So these are conventional asset classes. And in contrast, we have the alternative asset classes like private equity or also private debt. So these are not listed and not traded. And then we have listed and non-listed real estate. We have hedge funds, commodities, and finally cryptocurrencies. And the question is now, what are the typical characteristics of conventional and alternative asset classes? So let's have a look at the conventional classes first. And we have already seen that stocks and bonds are typically listed and publicly traded. And they are also highly regulated by authorities. And typically we can observe very high liquidity, so high trading volume. And actually, one obligation of listed companies is to provide plenty of information. So typically, the information is publicly available, and therefore these assets are pretty transparent. So conventional asset classes are highly transparent and highly regulated, and therefore there are no or very low barriers to investor trade. And that means that retail investors can trade and invest with just a few mouse clicks, and they just need a few dollars. And in contrast to that, alternative asset classes are unlisted or private, and they are typically unregulated. And as they are not listed and publicly traded, they are more or less illiquid assets. So there's no market or no exchange where we can trade private equity or private debt. And typically there's also a lack of information and transparency. And there do exist high barriers to invest or trade for retail traders and investors. So alternative assets are typically available only for institutional investors because authorities don't allow retail traders to invest, or they set very high minimum investments like 200 or 300,000. Now, cryptocurrencies are definitely not conventional assets, but when having a closer look on the characteristics, they don't really fit into the alternative asset class definition because most cryptos, and in particular the most popular ones like Bitcoin, can be traded on public exchanges. Second, cryptocurrencies are somewhat unregulated. At least they are not directly regulated by the authorities, but the Wild West times seem to be over because the cryptocurrency exchanges and brokers are more and more getting forced to comply with the rules and regulations. And as a consequence, in many countries, they have to restrict and or modify products and services offered to retail traders. And we will see this later in the Binance example. But now let's go on. And the most popular cryptocurrencies are highly liquid with high trading volume. And due to the blockchain technology, they are very transparent. So almost all information is publicly available. And therefore, there are very low barriers to invest or to trade. So you need a few dollars and some mouse clicks to buy Bitcoin. And the interesting question is now, will cryptos become a conventional asset class and an accepted currency like a US dollar and the euro in the future or not? And the best answer is clearly, we have to wait and see what the future holds. Now, as the name says, cryptocurrencies are currencies, and it's worth understanding the purpose of currencies, also called money. And thousands of years ago, people exchanged goods and services for goods and services. So, for example, 1 cow for 1,000 apples or whatever. And that worked, but there are many drawbacks of a so-called barter economy. And therefore, currencies and the concept of money more and more replaced the barter economy. So, money is a medium of exchange for goods and services, as long as it is widely accepted by market participants. And as a direct consequence, the benefits of money is that money is a store of value. And that means you can provide a service today and get paid for it with money. And then you can keep the money until you really need it to buy, for example, a car. And it's pretty clear that an apple or a chicken is not a good permanent store of value. But one requirement is that the store of value is stable and reliable over time. And that's why high inflation rates are bad. So inflation is the decrease of purchasing power of money. And too high inflation rates actually destroy that store in value characteristic. Last but not least, money and currencies serve as a unit of account. So money is a widely accepted standard to value goods and services and to make calculations. So for example, in the US, cars are priced in US dollar, and to buy a car for a price of, for example, 20,000 US dollar, we need 1,000 $20 notes. Finally, there do exist different types of currencies. So we have representative money, then we have fiat or fiat money, and finally we have virtual money, so cryptocurrencies. And initially people started to create so-called representative money, which were papers or certificates backed by a physical commodity like gold. So each certificate represents a bar of gold that is physically lying in a bank vault. And at any time, people could go to that bank and redeem the certificate for the bar of gold. And this was more convenient and more secure than just carrying the gold with you. Now, over time, people started to trust that piece of paper, and governments or central banks started to issue fiat or fiat money. And fiat is a Latin word, and it means that fiat currencies only have value because the governments and or central banks maintain that value. So they create and maintain the trust that it has value and that everyone accepts it. So there's no intrinsic value, and it's not backed by any physical asset. And the most popular currencies are actually fiat money. So the US dollar, the euro, the British pound, and so on. And they are issued by the authorities and also called legal tender. And fiat money is typically paper and coins. But of course, we can also store euro or US dollar in a digital way. And last but not least, we have virtual money, cryptocurrencies, and these are digital assets only. And most important, they are also not backed by real assets. And a cryptocurrency derives its intrinsic value from its native blockchain. And we could also say that a cryptocurrency is governed by blockchain protocols, the code, and the community. And we can conclude that fiat money and virtual money are different in many ways, but they also have one thing in common. So they are not backed by physical assets, and they only have value because people trust that they have value. So typically nowadays we don't see representative money. We have fiat money and cryptocurrencies, and both are built on trust. And if the trust is getting destroyed, then they no longer serve as a medium of exchange for goods and services, and they can no longer serve as a store of value. And people go back to the barter economy. And there's actually kind of a hybrid between fiat currency and cryptos. It's the so-called stable coins, and we will cover stable coins in the next lecture. Thanks for watching and see you there. Bye.